If you're part of a couple, figuring out how to manage money together can be challenging. Often couples move in together or they get married, and discussing finances is an afterthought. In my opinion, ongoing, open communication about money is critical for the success of your relationship and your finances. This podcast will review 8 money rules that happy couples follow. While there's no one-size-fits-all approach, I'm going to share how my husband and I have managed money together for decades. You'll learn some good tips for sharing a healthy financial life and avoiding common pitfalls as a couple. Welcome back, podcast friends. I really appreciate you joining me for Money Girl episode 880. I'm Laura Adams, an award-winning author, finance spokesperson, speaker, founder of the Money Stack, which is a Substack newsletter, and host of Money Girl with over 43 million downloads. If you're getting value here, please consider a 5-star rating or review. That always means so much to us. And if you have a question about money for the show, leave it on our voicemail at 302-364-0308. Of course, you can also send me an email and sign up for the free Money Stack newsletter when you visit lauradadams.com. When you subscribe to the Money Stack, you'll automatically get a fantastic free gift. It's my Money Success Toolkit. It contains a financial planning workbook and my personal financial statement calculator. It's a whole workbook where you can enter and track your net worth over time. That's the tool that I use. So I hope you'll enjoy those free gifts when you sign up at lauradadams.com. Okay, let's talk about 8 rules to ensure you and your partner or spouse have as much financial success as a couple as possible. Rule number 1, know your partner's financial history. Building and maintaining trust is essential, whether you're a brand new couple or you're considering taking your relationship to the next level. And I think that should include knowing each other's financial histories, like your income, debt, and credit. Now, the good news is that even if your partner has less than perfect credit, it doesn't hurt yours. However, qualifying for a joint credit account, we'll talk more about joint credit, but things like getting a mortgage or a car loan together could be more challenging. A great way to review your financial histories is to simply look at each other's credit reports. You can use a free site like Credit Karma. That's an excellent place to start. And your credit reports list every account you've opened in the past 10 years, even those that you've paid off or closed. Credit reports also show if you've paid accounts late or you've got legal issues like a bankruptcy, lien, or an account in collections. All of those would significantly hurt your credit scores. However, credit reports don't show information like your income, bank balances, or retirement accounts. Rule number 2, only merge money once your relationship is long-term. In general, I recommend managing money as a couple. However, I only recommend it if you're 100% committed and you plan on staying together long-term. That's because if you break up, unraveling your financial lives can be complicated, very complicated. For example, if you have a joint bank account, both of you own it and you can withdraw all the funds at any time. If you co-sign loans and credit cards and your partner doesn't pay their fair share, the lender will hold you responsible, and I'll talk more about the risks of sharing debt in a moment. The bottom line is that if you're uncertain how long your relationship will last or you've got any concerns about merging money with someone else, please don't do it. Rule number 3, create financial goals together. If you decide to merge money as a couple, defining and agreeing on your financial goals as a team is essential. For instance, what do you want to achieve over the next few years and the long term? You may want to plan a vacation, buy a home, start a family, or retire early. Many couples have different money personalities, like one being a really good saver who's always thinking about the future, and the other preferring to spend more, living more in the moment. So it's vital to acknowledge your financial tendencies and figure out how to meet somewhere in the middle so you're both happy. In my relationship, I'd say I'm, probably a bit more of a saver. My husband is probably a bit more of a spender, but neither one of us are on those extremes. So Our money personalities are not that different. So we're able to agree on goals and we're able to, kind of chart a path for the future that we're both really happy with. But I will say, that's not the case for every couple. And I'll talk more about, what to do when things don't align. Rule number 4, agree on a spending plan. Once you identify your money goals, consider how you'll pay for them and how you're going to handle expenses as a couple. My husband and I share everything. So our income goes into one bank account, and then I pay all our bills from that account. However, some couples may want to separate their incomes and certain expenses. In that case, splitting bills 50-50 may seem like a good strategy, but it may not work if one person earns significantly less. In that case, you might divide household expenses by percentages to make things fairer. For example, if your partner earns 35% of the total household income and you make 65%, you could pay 65% of the household expenses. However, if you go all in and merge your finances as a couple like I do, you won't have to worry about dividing expenses. I think paying bills from a joint account makes life a lot easier. However, as I mentioned, I only recommend doing that if you're in a 100% committed relationship. Rule number 5, understand the risks of sharing debt. When you co-sign a credit account, like a credit card, auto loan, or mortgage, you assume equal responsibility. So that means if one of you fails to pay a joint debt on time, you're both legally responsible for the entire debt, not just half of it. A co-signed account appears on both of your credit reports, so that means you can both build credit if your payments get made on time. But late payments will hurt both of your credit scores. So if you co-sign a credit account, be very sure that payments never fall through the cracks. Over the years, I've noticed an increasing number of unmarried couples buying homes together. And while that certainly makes housing more affordable, it could hurt your financial future if things don't go as planned. For instance, what happens if you disagree on managing the property? Or if one person has a financial hardship and wants to sell out? What if your romantic relationship turns sour and you break up? These are the kinds of issues that you've got to work out before you commit to buying real estate as a couple. You'll need to consider whether you have equal money or different proportions for a home down payment and whether you want to be responsible for a mortgage. To get approved, each mortgage applicant must show ample income, job history, and credit scores. If one partner has low income or poor credit, the other could be the sole mortgage applicant. But remember that you're not legally responsible for repayment unless your name is on a mortgage. Being named on a property deed indicates ownership, but that's not the same as having financial responsibility for a mortgage. If you buy a home and you're not married, you have a couple of legal options to choose from for ownership. You've got tenants in common. This gives each person a share of the property, like 50-50 or 75-25. When one tenant in common dies, their share goes to their heirs, not to the other owner or owners. And each owner can sell or give away their interest in the property. Now, you've also got joint tenants with a right of survivorship. This status gives each person the right to own the property when the other owner dies. So their interest automatically passes to the survivor, not to their heirs. Although married couples can own property as tenants in common or joint tenants, they have another option called tenancy by the entirety. This allows spouses to own property as a single legal entity. It protects each person because a creditor of one spouse can't attach and sell the interest of the property that the other spouse owns. And when one spouse dies, their interest automatically passes to the surviving spouse, just like with joint tenant ownership. So you'll need to think carefully about the legal status, the legal ownership that you want when you buy real estate with someone else. Rule number 6, know the spousal IRA rules. If you're married and file taxes jointly, both spouses qualify for an IRA even if one of you doesn't earn an income. This is an often underused benefit that many couples don't know about. So it's often called a spousal IRA, and it's not a different type of IRA. It's just a rule that allows income from a working spouse to fund a non-working spouse's traditional or Roth IRA. For 2024 and 2025, if both spouses are under 50 with a household income of at least $14,000, you can each contribute up to $7,000 to an IRA. If you're over 50, the maximum contribution increases to $8,000 each. Rule number 7. Communicate openly about money. I mentioned this at the top of the show. Even if your financial goals as a couple are aligned, a key to long-term success is communicating regularly. Unfortunately, I think many couples only talk about money after problems come up, and that's definitely the wrong approach. Instead, set a time each month or quarter to chat about your budget, your debt, your income, and the plans for the future. That will help you iron out any wrinkles in your relationship and ensure you're on track to achieve your financial goals. My advice is to be open-minded about changing strategies and setting new guidelines if the way you manage money as a couple isn't working. And number 8, get help from a financial professional when needed. Even if managing money is a breeze for you and your partner, it's often wise to get help from a financial pro, like a financial advisor, retirement planner, tax accountant, estate planner, or real estate attorney. If money is causing problems in your relationship that you just can't seem to work out on your own, get help. Don't suffer alone. Speak with a therapist or a couples counselor who can help you find solutions. Often getting an outside opinion and somebody to, really ask key questions is how you're going to get through some money problems and hardships in your relationship. Yes, professionals cost money. However, I've always found that getting good advice usually pays off. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. I want to thank our amazing team. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.